would you rather lend money to? A country whose debt is nearly 100% of its GDP? Or a country whose debt is roughly half of that? A country expected to grow at 2%? Or a country with an average growth rate of 5%? The answer should be simple, but for many investors it's not. Many emerging market countries like Brazil, Mexico, and Indonesia have lower debt levels and are growing faster than developed countries like the US or Japan. Yet many income investors choose to invest only in the United States or a few specific countries, shunning the currently higher yields in emerging markets. In many cases, these emerging market issuers have better credit metrics than their developed market counterparts. US Treasuries were downgraded in 2011, while Indonesia was recently upgraded to investment grade. Portugal was downgraded in 2011, while Brazil, its former colony, was upgraded once again. Spain has been downgraded, while Mexico has had investment grade status for years. Many of these emerging countries also have younger populations, a growing middle class, credible central banks, and stable governments. There are a lot of other developing countries with much the same story. Good balance sheets and strong growth, while currently offering higher yields on their debt. With yields on US bonds likely to stay low for quite a while, we believe investors should look beyond the US and globalize their portfolios. Many emerging markets are more creditworthy than investors give them credit for.
Fixed income investing entails credit risks and interest rate risks. When interest rates rise, bond prices generally fall, and the fund's share prices can fall. Investments in emerging markets and developing markets may be especially volatile. These views represent the opinions of Oppenheimer Funds, Inc. and are not intended to be investment advice or to predict or depict performance of any investment. These views are subject to change based on subsequent developments. Copyright 2012 Oppenheimer Funds Distributor, Inc.